Yo, what's up everyone? I'm Mark with Kendrick Research, and today is New Year's Day. 2023 has been an insane year, and as you can see, the market has done incredibly well, with the Nasdaq being up over 40% and the S&P 500 being up over 20%. But we've managed to outperform the market with the Kendrick Research portfolio being up over 58%. If you would have asked me at the beginning of the year if we would be up this much, I probably would have said, probably not. But if you would have asked me if we could beat the indices, I think I would have said yes, we can. In this video, I want to talk about my strategies, my results for the year, my current positions, and my 2024 outlook and goals. And let me know, guys, this is the first time I'm making a video of this kind. Do you like this content? Do you want to see more? I'm thinking about doing a portfolio update video once a month or once a quarter. Right now, I'm just posting my moves and weekly buys on X, so if you want to stay up with the more day-to-day, then follow me at Kendrick Research on there. But if you want to see more videos like these on YouTube, please comment, like, and most of all, subscribe. Alright, with that, let's jump right into it. So here's the Kendrick Research portfolio. It is currently at $51,462 and has a total of 8 positions and about $9,000 of unrealized gains. We'll take a look at each position, all of my DCAs into these positions, but before we jump into each one, let's review the Kendrick Research strategy. The public portfolio is centered around 5 key strategies. The first 3 are what I'm looking for in a stock, and the last 2 are how I invest. For the first one, I'm looking for asymmetric risk reward. I want investments with higher upside potential than downside risk. I do not want some short-term trending stock that has already gone parabolic. Second, I want high-growth companies, ideally double digits for top and bottom line, and companies with large moats that are not easy to disrupt. Third, I want industry-leading companies or disruptors, companies that not only take market share within their industry, but grow the market when they grow. Fourth, I invest with high conviction in highly concentrated positions. I do not want hundreds of positions to manage. I want 10 to 15 that I know extremely well. Lastly, I DCA with a long-term investment horizon. This portfolio is in a taxable brokerage account, so I want to hold everything for at least 1 year before I even consider selling. Now, let's take a look at our first position. Our first position is Amazon. Amazon is my highest conviction company and is the rock within this portfolio at 30% weighting. We are nearly up 21% this year on this stock on a cost basis of about $126. Here's all of our DCAs this year. We've bought 9 times in almost every month starting in April. This stock has done pretty well over 5 years, but is down from its 2021 highs as it had a major pullback during the 2022 crash. We didn't catch the very bottom, but I'm very happy with our current cost basis on the stock. In terms of why I'm invested in this company, Amazon is simply a revenue growth beast. Quarter in, quarter out, this company grows its revenue. To me, this company could easily be the most valuable company in the world in the next 5 years. They're likely going to be the first company to have its revenue surpass $1 trillion per year. Additionally, they are increasing focus on operating income and earnings, which are now growing faster than revenue. From a valuation standpoint, Amazon is nearly as cheap as they've ever been, with a price-to-sales ratio of less than 3, which is not very expensive given their growth. As for their PE ratio, they are trading for about 80 times, but given all their earnings levers, this higher ratio does not concern me. Lastly, they have a beast balance sheet with assets far greater than liabilities and almost $65 billion in cash. To me, this company is easy money and there is no risk to their business model. Alright, the second position in the public portfolio is PayPal. We are slightly down on this position with an average cost of $62.43. In terms of our buys, this is one we've DCA'd since June with buys from $50 per share all the way up to $72 per share. This is one of the super beaten down dog stocks that is still not recovered from its 2021 highs through 2023, but is one of the highest risk-reward companies in the stock market today. Check this out. This is PayPal's income statement quarter over quarter for the last 2 years. They've continually grown revenue and over the last year have significantly grown operating income. In terms of valuation, They are trading for a modest 18 to 19 times current earnings, but if you look at their PE ratio historically, this is significantly below trend. On top of that, they have just named a new CEO, Alex Chriss, who began in September this year and who has an incredible track record with Intuit, one of Wall Street's most beloved stocks. If you have not listened to Alex's first PayPal earnings call, I highly encourage you to. It was one of the best earnings calls I've ever heard, with Alex providing clear direction in the company and specifically focusing on profitable growth. Here's a quick look at Intuit's stock price over the last 20 years while Alex has been part of the company. If he can execute and accelerate profitable growth for PayPal, this is going to be a fun ride. Lastly, on top of a cheap valuation and a high-performing new CEO, PayPal is also buying back $5 billion of their own shares. This is a company I wouldn't be surprised to see over $100 per share pretty easily next year. The third position in our portfolio is Shopify. This is a high-growth Canadian company that is the backbone for e-commerce sites around the world. It currently represents about 15% of the portfolio at an almost 30% gain with a cost basis of about $60 per share. This stock we started DCAing in July with some of our latest buys into November this year. This is another stock that took a huge hit in 2022 and is yet to fully recover to its all-time highs. In terms of why I love this company, look at their consistent revenue growth. Even with high interest rates and a debatable recession in 2022, they continue to grow revenue every single quarter. Additionally, they have become operating income positive, which means if they continue this trend and move to a consistent, profitable growth company, more and more investors will want a piece. Lastly, Shopify has now built out 1 full year of free cash flow positive results. This represents a significant change in business model, which I think could highly reward investors. The next position in the public portfolio is Robinhood. This company was an incredibly fast winner for me, up over 56% on a cost basis of about $8. All of my DCAs for this stock were in about a 2-week span in mid-November. As I saw the company sell off to nearly cash value, I couldn't help but take advantage of the opportunity. In my experience, if a company is trading for cash value and is growing revenue and not about to go bankrupt, it's time to buy. Here's Robinhood's P&L, which has seen significant revenue growth, and though it is not profitable now, I could see this changing over the next 2 years. The fifth stock in the public portfolio is Palantir, which is the biggest percent winner in the portfolio, up nearly 100%. Palantir is an AI leader in the intelligence and defense space with presence all over the world. They are also growing quickly in the commercial space with new AI products which are customized to each client and their data. This one I only bought lightly in this portfolio as I have 2 other portfolios with super heavy Palantir positions. In this portfolio, I only have 2 buys, one in May and one on a big dip in September. If prices ever reach back into the $14 to $15 range again, I will continue to build this position within this portfolio. Palantir went public in 2020 and had a huge spike in price before coming down in 2021 and 2022. Currently, Palantir is trading pretty richly at about 18 times sales, but their profitable growth trajectory is just starting. Palantir's newest product, AIP, is growing like crazy, and we should start to see the impact of these new sales in next quarter's earnings. Even without AIP's full impact, Palantir has continually grown revenue through a tough interest rate environment, and in the last year, done so profitably, which has made them eligible for S&P 500 inclusion. This would highly increase the amount of investors exposed to the stock. I would not be surprised to see Palantir in the $25 to $30 per share range in the next year. Our next stock in the public portfolio is Tesla. Tesla is a brand new position that I just opened on the last trading day of the year. This is a position I plan on continuing to build out in 2024. This stock has done incredibly well over the last 5 years, returning investors nearly 10,000%. But over the last 2 years, with higher interest rates, the stock has seen some softness. Even with these headwinds, I could see somewhere in the future Tesla being the world's first $10 trillion company. Elon Musk is the modern inventor our grandkids will be learning about. With major innovation coming down the pipeline, from Cybertruck currently being rolled out to the Tesla Semi and Optimus, Tesla will continue to grow through any economic environment. I mean, check out their revenue. Every quarter they grow, no matter the headwinds. As we see Cybertruck sales impacting results, I'm confident revenue will re-accelerate in years and quarters to come. Our seventh position in the public portfolio is ChargePoint. ChargePoint is the leader in EV charging with over 30,000 charging locations globally. This is another new position and is a smaller spec play at less than 3% weighting. With the heavy sell-off in the stock over the last 3 years, I think this company could be nearing a bottom. As ChargePoint continues to scale their business and the economies of scale start to work in their favor, and with the continuation of EV growth globally, I think ChargePoint could someday be a household name. Even though ChargePoint had its first non-revenue growth quarter, its valuation is still less than 2 times sales and is simply too cheap for me to pass up. I will continue to nibble on this stock through 2024. Our last and final stock in the public portfolio is another spec play. Flux is a lithium-ion battery company with high growth and a dirt cheap valuation. This stock I just bought for the first time in December, and it is a super microcap at only a $60 million valuation. Over the last 3 years, the stock has been crushed, even though their revenue has continued to grow. Their revenue is growing at over 30% year over year, and they are now trading at less than 1 time sales, which to me is too cheap to pass up. But buyer beware. This is a money-losing company, so you always have to be careful. Alright, so that's it for the full portfolio review. I had a couple other winner positions this year that I closed out, which contributed to my overall portfolio gains, including Coinbase, Grayscale Bitcoin Trust, Intel, and Meta, but I didn't want this video to get too long. As for 2024 goals and outlook, my first goal is to simply stay consistent to the strategy. It's easy to get caught up in the momentum trades, but I don't think those will win in the long run. I'm going to continue to DCA every single Friday, and my buys will vary with my conviction, but I plan to add between 500 and 2,000 every week. Third, I want to build out this portfolio a bit more. I've really only consistently been adding to this portfolio since May 2023, and I think it could use 2 to 6 new positions to help round it out. And to that point, fourth, I want to add some dividend growth stocks. I think there are tons of excellent companies in this space, and it will help balance my portfolio. With that, thank you so much for watching. If you stayed to the end and enjoyed the video, please like and subscribe, and comment any investment ideas you have below. I'd like to hear your thoughts and ideas. Again, thank you kindly, and until next time, Mark, out.